The trade that hurts people the most is often the one that finally works without them. You watch a stock climb for days, sometimes weeks. You tell yourself it's too high. You wait for a pullback. The pullback never comes. Then, after you've spent all that time looking for the perfect entry, the move is gone. What's uncomfortable is that many traders don't lose money because they buy too high. They lose money because they spend their entire careers trying not to buy high. Have you ever noticed how easy it feels to buy something that's falling? It looks cheaper. It feels safer. Yet somehow those positions often become the ones that demand the most patience, the most hope, and the most explanations. There's a reason for that. A strong market rarely advertises itself at a discount. When demand is truly overwhelming supply, prices rise. That's what strength looks like. The crowd sees a higher price and assumes greater risk. The market sees a higher price and says demand is still winning. So when I say I buy at the top, I don't mean I buy random highs. I mean I buy strength when strength proves itself. Think about it for a moment. Why is a stock making a new high in the first place? Someone is willing to pay more today than anyone paid yesterday. That fact alone doesn't guarantee future gains. But it tells you something important. Buyers are aggressive enough to keep pushing price higher despite every reason not to. And where do the biggest moves usually begin? From weakness that everyone can see, or from strength that most people are afraid to trust? The answer matters because traders often confuse price with value. They assume a lower price means a better opportunity, yet markets are not department stores. A stock down 50% can easily fall another 50%. A stock making new highs can continue climbing because institutional demand has not finished its work. This is where psychology becomes expensive. The human mind wants confirmation before commitment. It wants certainty before risk. But markets reward those who recognize evidence before certainty arrives. By the time everyone agrees a trend is real, much of the opportunity has already passed. So what do I look for? I look for stocks that refuse to fall when they should. I look for breakouts that attract volume instead of hesitation. I pay attention to how price behaves after good news, after bad news, and during market weakness. Why? Because behavior reveals conviction. A stock that continually absorbs selling pressure is telling a story. A stock that keeps returning to new highs despite profit taking is telling another story. The message is often clearer than any opinion you can find. Now, does this mean every new high should be bought? Of course not. The important distinction is whether you're buying a price or buying a condition. The price is visible to everyone. The condition behind that price is what separates professionals from spectators. The mistake isn't that traders enter too late. The mistake is believing they must enter before the market reveals its intentions. Think about how often people become obsessed with catching the exact turning point. They want to buy before the breakout, before the trend becomes obvious, before everyone else sees it. The earlier they are, the smarter they feel. But the market does not reward anticipation by itself. It rewards being right. There is an important difference. A prediction is an opinion about what might happen. Confirmation is evidence that something is already happening. One depends on your imagination. The other depends on the market's behavior. Which one do you trust more? When a stock approaches a significant high, traders often become uncomfortable. They look at the distance it has already traveled and assume the opportunity is gone. What they fail to notice is that the market is answering a question. Can demand absorb all the selling at this level? That question matters because major highs are rarely quiet places. Traders take profits. Skeptics sell short. Early buyers cash out. Supply enters the market from multiple directions. If price pushes through anyway, something important has been proven, not predicted. Proven, this is why I wait. Waiting is not hesitation. Waiting is observation. I am not looking for a reason to buy. I am looking for evidence that buyers are stronger than sellers at a price level where sellers should have an advantage. Notice the cause and effect relationship. If price cannot overcome resistance, then demand is not strong enough yet. If price breaks through and holds, then demand has demonstrated strength. The market has shown its hand. Only then do I become interested. Have you ever entered a trade because the setup looked perfect, only to discover that the market disagreed. Every trader has. The chart seemed ready. The story sounded convincing. The logic appeared solid. Yet price moved the other way. Why? Because your analysis was trying to lead the market instead of follow it. The market's opinion is the only one that moves price. Confirmation forces you to respect that fact. This approach requires patience because evidence arrives later than prediction. That's the trade-off. You give up the privilege of being first. In return, you gain information, and information changes the quality of a decision. Consider two traders looking at the same stock. One buys because he believes a breakout will happen. The other waits until the breakout actually occurs. The first trader is betting on a possibility. The second trader is responding to a fact. Those may sound similar, but they are fundamentally different actions. One is asking the market to prove him right. The other is allowing the market to prove itself first. That distinction becomes even more important during uncertain conditions. Markets often create false starts, temporary rallies, and promising patterns that never develop further. Prediction treats every possibility as an opportunity. Confirmation filters possibilities through evidence. The market eliminates weak ideas before your capital has to. So when you see me buying near highs, understand what is really happening. I am not chasing price. I am waiting for a test to be completed. I want to see whether the market can do something difficult before I commit money. Can it overcome supply? Can it hold above resistance? Can it continue advancing after attracting attention? Those answers are worth far more than a slightly better entry price. One of the most expensive assumptions in trading is that a lower price automatically means a better opportunity. It sounds logical. If a stock was trading at 100 and now trades at 80, many traders see value. If another stock rises from 100 to 120, they see danger. But the market does not calculate opportunity the way people do. The market is not concerned with how far a stock has traveled. It is concerned with where it is likely to go next. That distinction changes everything. When traders talk about price, they often speak as if price itself creates risk. Yet price alone tells you very little. A stock trading at 20 can be extremely risky. A stock trading at 200 can be relatively safe. Why? Because risk is not determined by where a stock has been. It is determined by what the probabilities suggest from this point forward. Imagine two situations. In the first, a stock declines from 100 to 70. In the second, a stock advances from 100 to 1 per 30. Which one offers the better opportunity? Most people immediately focus on the distance already traveled. They assume the cheaper stock has more room to rise and the stronger stock has less room remaining. But that assumption has no mathematical foundation. The market does not owe either stock a move in the opposite direction. A stock down 30% does not become more likely to rise simply because it has fallen. A stock up 30% does not become more likely to fall simply because it has advanced. Future movement depends on future demand and supply, not on the trader's sense of fairness. This is where expected value enters the conversation. Every trade is a probability problem. The question is never, has this moved too far? The question is, from this point, what is more likely to happen next? If a stock continues demonstrating strength, then the probability of additional upward movement may exceed the probability of meaningful decline. If that probability remains favorable, the higher price may actually offer the better opportunity. Notice what happens when traders ignore this. They become anchored to the past. They compare today's price to yesterday's price. They compare current levels to old levels. They mentally calculate what they missed. As a result, they stop evaluating future probabilities and start reacting to historical prices. The market does not reward that behavior. A trader who buys solely because something is lower is often paying for possibility. A trader who buys strength is often paying for evidence. And evidence affects probability. A stock that continues advancing is revealing information. It is showing that buyers remain willing to transact at increasingly higher prices. Whether the stock eventually succeeds or fails is a separate question. What matters is that each new piece of evidence changes the odds. Have you ever noticed how professional traders rarely speak about cheap prices? They speak about favorable situations. Those are not the same thing. A cheap price describes where something trades. A favorable situation describes the relationship between risk and potential reward. The two can exist together, but they are not connected by default. This is why I am willing to pay more. Not because I enjoy paying higher prices. Not because higher prices guarantee success. I pay more when the additional information gained from market behavior improves the probability of a favorable outcome. That extra 20 points in price may look expensive on a chart, but if those 20 points reveal that the odds have shifted meaningfully in your favor, then the higher price may actually be the cheaper decision. When a stock reaches a new high, most traders focus on the price. I focus on the battle that had to occur for that price to exist. Price is not the event. Price is the result. Behind every new high is a process. Buyers and sellers have been negotiating for days, weeks, sometimes months. Every transaction represents disagreement. One side believes the stock is worth owning. The other side believes it is worth selling. The chart only shows the final score. The important question is this: what does that score reveal about the balance of power? Think about what a major high actually represents. At that level, there are usually plenty of willing sellers. Some investors are taking profits. Others are reducing risk. Some believe the stock has gone too far. Others are betting against it entirely. Supply is not absent. In fact, supply often increases near important highs. Yet sometimes price continues rising anyway. Why? Because demand is absorbing everything offered to it. That is the detail most traders overlook. A stock does not reach higher ground because sellers disappear. It reaches higher ground because buyers are willing to transact faster and more aggressively than sellers can distribute shares. The relationship matters because markets move according to imbalances. When supply exceeds demand, prices decline. When demand exceeds supply, prices advance. Every trend, every breakout, every major move is simply the visible expression of that underlying equation. Now consider what happens when a stock repeatedly approaches a resistance area. The first attempt fails. The second attempt struggles. The third attempt pushes closer. Each test provides information. Sellers are being forced to reveal their inventory. Buyers are repeatedly returning, despite previous setbacks. Over time, shares move from weaker hands to stronger hands. The market is gradually changing its internal structure. Then one day the level breaks. To an inexperienced observer, it looks sudden. To someone studying supply and demand, it is often the logical conclusion of a process that has been developing for weeks. The breakout itself is not the story. The exhaustion of available supply is the story. Have you ever wondered why some breakouts explode while others barely move? The answer often comes back to the same principle. If sellers still possess substantial inventory, upward movement encounters resistance quickly. If most willing sellers have already acted, price can advance rapidly because there is less supply standing in the way. A market does not need extraordinary buying to rise sharply. Sometimes it only needs a shortage of selling. That realization changes how you interpret strength. Instead of asking, has this stock gone too high? You begin asking, what does this movement reveal about the relationship between buyers and sellers? The focus shifts from price levels to market behavior. Every new high becomes a clue. Not a guarantee, not a prediction, a clue. The market is constantly broadcasting information through its movements. Strong advances suggest persistent demand. Weak advances suggest limited conviction. Failed breakouts suggest supply remains dominant. The chart becomes less about patterns and more about evidence. And evidence accumulates. When a stock repeatedly demonstrates an ability to absorb selling pressure, recover from challenges, and continue advancing, the market is telling you something about the forces operating beneath the surface. You may not know who is buying. You may not know why they are buying. You may not know how long they intend to continue. But you can observe the effects. The effects appear in price movement because price is where every opinion, every expectation, every piece of information, and every transaction eventually meets. That is why I pay attention when a stock reaches new highs. Not because I am impressed by the number itself. The number is merely the footprint. I am interested in the force that left it there. One of the quietest shifts in a trader's career happens when he stops asking what he thinks and starts asking what the market knows. At first, the difference seems small. In practice, it changes everything. Most trading decisions begin with an opinion. A trader studies a chart, reads a report, hears a story, or develops a theory. From that point forward, he starts looking for evidence that supports his conclusion. The problem is not having an opinion. The problem is becoming loyal to it. Because once a trader becomes attached to an idea, every piece of information gets filtered through that attachment. Bullish evidence feels important. Contradictory evidence feels temporary. The decision becomes less about observation and more about defending a position. The market has no interest in those defenses. It does not reward conviction. It rewards accuracy. That is why evidence matters more than opinion. An opinion is something you bring to the market. Evidence is something the market gives back. And those are very different sources of information. Think about a stock approaching new highs. There will always be reasons not to buy it. Some reasons may even sound intelligent. The valuation might appear stretched. The move may seem extended. The news could already be widely known. Analysts may disagree. Commentators may warn of danger. All of that may be true. Yet if the stock continues advancing despite those objections, what should command more attention? The arguments or the behavior? The answer is not philosophical. It is practical. Price movement represents the combined actions of thousands or millions of participants. Every buyer, seller, institution, fund manager, and speculator leaves a footprint in the market. Their collective behavior becomes evidence. Your personal opinion remains only one opinion, which carries greater weight. This is why I became less interested in being right and more interested in being informed. There is an important distinction. A trader who wants to be right often acts as a forecaster. He attempts to predict what should happen. A trader who follows evidence acts more like an observer. He studies what is actually happening. Prediction begins with a conclusion. Observation begins with a question. That difference affects every decision that follows. Suppose you believe a stock is overvalued. That is an opinion. If the stock continues making higher highs and attracting persistent buying, that is evidence. Now you face a choice. Will you trust your theory about the stock, or will you trust the behavior taking place in front of you? Many traders choose the theory. The market often chooses the behavior. And the market's vote is the only one that affects price. Have you ever watched a stock continue climbing while every logical argument said it should fall? Of course you have. Every experienced trader has. Moments like that reveal an uncomfortable truth. Markets can remain indifferent to our reasoning for far longer than we expect. That is why evidence deserves priority, not because evidence guarantees success. Nothing in trading guarantees success. Evidence simply places your decisions closer to reality. Reality is where money is made. When I see strength persist, I do not ask whether it matches my expectations. I ask whether it exists. When I see demand continue overcoming obstacles, I do not argue with it. I acknowledge it. The goal is not to prove your intelligence. The goal is to align yourself with what the market is already demonstrating. That requires humility, because evidence often arrives carrying a message we did not want to hear. Yet the traders who last the longest learn to treat market behavior as the final authority. Not because the market is always right in some philosophical sense, but because it is always the mechanism through which gains and losses are ultimately decided. The stocks that deserve your attention are rarely hiding. That may sound obvious, but watch what traders do every day. They spend hours searching through weak charts, neglected sectors, and damaged stocks, hoping to discover something nobody else has noticed. They treat trading like a treasure hunt. The less obvious the opportunity appears, the more attractive it becomes. Meanwhile, the strongest stocks are sitting in plain sight, making new highs, leading their industries, showing persistent demand. Yet many traders ignore them because they seem too obvious. That habit reveals an important difference between amateur behavior and professional behavior. Professionals spend less time searching for secrets and more time observing leadership. Why? Because leadership contains information. When a stock consistently outperforms its peers, it is separating itself from the crowd. It is attracting capital, while other stocks struggle to do the same. It is becoming the destination rather than the alternative. That process rarely happens by accident. The market is competitive. Thousands of stocks compete for attention every day. Most fail to attract meaningful demand. A small number rise above the rest. Those leaders deserve study. Not because every leader becomes a great trade, but because leadership itself is evidence of unusual strength. Over time, this changes how you organize your daily work. Instead of beginning with the question, "What can I buy?" you begin with a different question. Who is leading? Notice how much that simplifies the process. You are no longer evaluating the entire market equally. You are identifying where capital is already concentrating. The market is helping narrow your focus. That matters because attention is a limited resource. Every hour spent studying weak stocks is an hour not spent understanding the strongest ones. Every chart you analyze carries an opportunity cost. Professionals understand this. They know that finding opportunities is often less important than filtering distractions. Have you ever noticed how market leaders tend to appear repeatedly on your watch list? They remain strong while others rotate in and out of favor. They continue attracting demand through changing conditions. They refuse to disappear. That persistence is valuable information, because strength that survives over time becomes more meaningful than strength that appears for a single day. This is why I keep returning to the same names. Not out of loyalty, not because I have fallen in love with a stock. I return because leadership deserves continuous observation. The market is constantly revealing which stocks command attention and which stocks are merely participating. A professional develops the habit of recognizing that distinction. The routine itself is simple. Each day, identify which stocks are acting best relative to the rest of the market. Observe which names continue advancing while others hesitate. Observe which stocks recover quickly from weakness. Observe which stocks maintain leadership even after significant advances. You are not trying to predict anything. You are building familiarity. And familiarity creates recognition. The more time you spend studying leaders, the faster you recognize meaningful behavior when it appears. Patterns that once seemed hidden become obvious. Changes in character become easier to detect. That advantage does not come from intelligence. It comes from repetition. Day after day, you are training your eyes to focus on the strongest merchandise in the market. That habit creates a subtle shift. Instead of reacting to headlines, rumors, or random opportunities, you begin operating from a prepared list of proven leaders. Your attention becomes directed rather than scattered. The entry receives most of the attention. The management determines most of the outcome. This becomes especially clear when buying near highs. People assume the difficult part is pulling the trigger. They imagine that purchasing a stock at an elevated price requires unusual courage or conviction. In reality, that decision takes only a moment. The real challenge begins after the order is filled. Because from that point forward, the market starts asking questions. Was the move genuine or temporary? Will demand continue or disappear? Can the stock sustain its strength? Your answers no longer matter. Only the market's answers matter. That is why trade management becomes so important. When buying strength, the objective is not to prove that every trade will work. The objective is to determine quickly whether the conditions that justified the trade are still present. A stock reaches a new high because something favorable is occurring. The moment that favorable condition disappears, the trade changes. Many traders fail to appreciate this distinction. They treat the entry as the decision and the management as an afterthought. Professionals often view it the other way around. The entry simply creates an opportunity. Management determines how that opportunity is handled. Think about what happens after a breakout. Some breakouts continue advancing almost immediately. Others hesitate. Some reverse completely. All three outcomes begin from the same entry point. The difference appears afterward. That means the trader's job cannot end at execution. It must continue through observation. You are watching for evidence that the trade is behaving as expected, not perfectly, just reasonably. A strong stock does not need to rise every day. Markets rarely move in straight lines, but strength should continue expressing itself over time. Progress should remain visible. The reason is simple. The original thesis was based on strength. If strength disappears, the basis for the trade weakens. Cause and effect remain connected. The trade was entered because demand appeared dominant. If demand no longer appears dominant, the situation has changed. That is not an emotional judgment. It is a practical one. Have you ever noticed how traders become strangely passive after entering a position? Before entry, they analyze every detail. After entry, they stop evaluating and start hoping. The trade becomes something they own rather than something they monitor. That shift creates problems. Ownership encourages attachment. Observation encourages objectivity. The market rewards the second far more often than the first. This is why trade management requires continuous attention to behavior, not predictions, not opinions, behavior. How is the stock responding to market weakness? How does it behave after periods of consolidation? Does strength reappear when opportunities arise? Every answer provides information about the quality of the position. The market is not asking you to forecast the future. It is presenting evidence in real time. Your responsibility is to respond appropriately. That response may involve patience. Strong stocks often require time to develop, but patience and neglect are not the same thing. Patience means remaining engaged while allowing the trade room to work. Neglect means abandoning observation altogether. The distinction matters because opportunities evolve. A position that continues behaving well may deserve continued participation. A position that stops behaving well may require a different response. Both decisions emerge from management, not entry. This is why I never judge a trade by where it began. I judge it by how it develops. An entry is only the opening sentence of a much longer story, and the traders who focus exclusively on entries often miss the fact that the largest gains and the most important decisions usually occur long after the buy order has been placed. Some of the worst trades begin with a sentence that sounds perfectly reasonable. It's already down so much. That idea has probably cost traders more money than they realize. A stock falls 20%, then 40%, then 60%. At every stage, it appears increasingly attractive. The lower it goes, the stronger the temptation becomes. Traders begin seeing opportunity not because of what the stock is doing, but because of what it has already done. The decline itself becomes the argument. That is where the trap begins. A falling stock creates a powerful illusion. It creates the appearance of value without proving the existence of demand. Those are very different things. A stock can become cheaper relative to its past price, while becoming less attractive relative to its future prospects. The chart may look discounted. The market may be communicating deterioration. Price alone cannot tell you which is true. Yet many traders continue treating lower prices as evidence. In reality, lower prices are often the result of evidence. Something caused sellers to become more aggressive than buyers. Something shifted the balance enough to push price downward. The decline is not the opportunity. The decline is the message. The mistake occurs when traders focus on the opportunity and ignore the message. Have you ever noticed how bargain hunters are constantly waiting for a reversal? The stock falls. They expect a bounce. It falls further. They expect a larger bounce. It falls again. They become even more convinced. Each decline strengthens their belief rather than challenging it. The market keeps presenting evidence, yet the trader remains committed to a conclusion. This creates a dangerous cycle, because every new low encourages another purchase. Every purchase increases commitment. Increased commitment makes objectivity more difficult. The trader becomes emotionally invested in being correct. Meanwhile, the stock continues doing exactly what it has been doing all along. Falling. There is a practical reason this happens. Weak stocks often attract sellers for extended periods. Large holders may still be reducing positions. Institutions may still be exiting. Negative developments may still be unfolding. The process can continue far longer than expected because supply does not disappear simply because price has declined. A stock does not become strong because it is lower. It becomes strong when buying pressure begins consistently overcoming selling pressure. Until then, the decline itself provides no evidence that conditions have improved. That distinction is critical. Many traders study weakness looking for signs of future strength. The problem is that weakness often creates more weakness. A declining price damages confidence. Damaged confidence encourages selling. Additional selling creates further declines. Cause and effect reinforce one another. The trader who keeps buying into that cycle is constantly fighting the market's current direction. Not because the stock cannot recover someday. It may recover. But someday is not evidence. Someday is speculation. The market rewards evidence.